Hi, I'm Mal from the Money Study, bringing you another episode of our Take 10 Challenge. And here we are, number 96, another episode in our buying an investment property, up to part 5 of that. And this is all about getting that deposit organised for our investment property and that horrible thing called stamp duty. There's our disclaimer, facts and figures, information only, nothing to do with advice in today's video. Okay, so we're going to buy an investment property perhaps. We might even be our second, third or fourth investment property. But it comes down to the situation that the bank wants to know how we're going to pay for this thing. And yep, they still in theory need a deposit. Just like we were talking about deposits and so forth for our first home buyer, then yep, even as an investor, they still want to see this equity compared to the loan, this loan to value ratio, ensuring that we've got at least 20% value when we turn around and buy this thing. So yep, we can either use 20% deposit. So if we're buying a $500,000 property, we can pull $100,000 out of our lazy money and turn around and buy our property and borrow the rest. Now, of course, if we don't have that lazy $100,000 lying around, but we do indeed have our plenty of equity in our own home, then yes, we can use the equity in our own home as effectively for the deposit. And effectively what we're doing there is we're borrowing the entire lump of money to buy the investment property. So literally they just add the two values of the two properties, look at the total loan, and so long as the total loans compared to the total value is under that 80% mark, then we can avoid that thing called lender's mortgage insurance. Now, because we talked about that lender's mortgage insurance in episode number 85, it applies exactly the same way to investors as well, because we try and avoid it. So we try and use our equity, we try and use our real lump of money stuff here to effectively get into our investment property. But it all literally just comes down to this loan to value ratio. What is the total loans compared to the total value? That's all it comes down to. So you could have the equity in your own home could indeed be for the deposit on 2 more houses, so long as the total loans aren't more than 80% of the total value of all the property. If so, then we're up for some mortgage insurance. And we'll talk about stamp duty in a sec, but just as a recap on this lender's mortgage insurance, you can see why we're trying to avoid it. We really are trying to avoid getting lender's mortgage insurance if we've got to turn around and pay, let's say, like on a $600,000 unit or something like that, and we've only got a 5% deposit, then effectively, ouch, our lender's mortgage insurance is becoming quite expensive there. And of course, the bigger the debt, the bigger the mortgage insurance, and so it goes on. So mortgage insurance can be an extra cost, which we're trying to avoid. But the other thing we really is going to hurt us hard in the purchase of our new property is this thing called stamp duty. Now, stamp duty is a state tax. It's a state tax. It's not a Commonwealth tax, and so it varies from state to state. When I did these slides, they were the appropriate places to go to. I'm assuming they are still the appropriate websites for you to go to find out about your stamp duty. Most of them have like a calculator, so you can put in how much money that the purchase price is, and it'll tell you what the stamp duty is. And generally speaking, there are different rates there for depending on whether it's a first home buyer and so forth. Some of the states have different levels, depending on whether it's an investor or it's for your own home and so forth. So just make sure you're looking at the right numbers, you're doing the right calculation, and of course, if in doubt, contact them to find out before you get some sort of a bit of a rude shock there when we finally do come around to buying our property. So as a rule of thumb, 3 to 4% of the property value. This is we try and negotiate, and if we can get a 5% discount by discount, by talking to people and say, oh gee, we got it cheaper, which is probably unlikely in this environment. But if you can ever get to the point of negotiating down, then yep, if we can get a 3 or 4%, we think we're doing okay. Then of course you might as well just add it back in again, because now we're going to turn around and pay stamp duty. But of course, obviously, the lower the price, the lower the stamp duty. Higher the price, the higher the stamp duty. On a $500,000 house, these numbers were from 2020-22. But you can see, look, quite a significant difference there. And of course, some of the states are trying to get rid of stamp duty. They're trying to get rid of the stamp duty because what they're doing is they're increasing rates. And so that, it's not such a burden for younger people getting into the property market. So there's not a lot we can do. I mean, obviously, stamp duty is the thing that the government is imposing upon us. Just to make sure that we just take this into account. As I say, a lot of people work out, okay, we've got a certain amount of money, we're going to go and buy a property, but then they forget about all these extra costs in getting in. And if you've got to add another 3-4% with the thing called stamp duty, this can certainly be a significant amount of money that we've got to then turn around and find. So it's just a case of going into our purchase with a bit of open eyes. Happy to talk about it, and look forward to joining us on the next episode.